Hey traders, Mike Sir here. In today's video, I'm going to profile the most successful hedge fund in the world and its billionaire founder, Ray Dalio, and share with you his unique philosophy and approach to investing in the financial markets. Now make sure you watch the entire video as I will explain in detail 3 of Ray's most important investment philosophies that you can apply to your own investment portfolio right now. So let's get started. Ray Dalio is a name synonymous with success in the financial markets. And upon graduating from Harvard with a degree in finance, Ray took a job on the floor of the New York Stock Exchange as a commodities futures broker. However, he soon realized that the traditional approach to investing was not sufficient for the complexities of the financial markets. Now, this realization laid the groundwork for him to found his own hedge fund called Bridgewater Associates. Now, Bridgewater Associates was initially a small operation, but it quickly grew into one of the most influential and successful hedge funds in the world. Now, Ray Dalio's approach was rooted in the principles of global macro investing, which involved making large bets on the direction of entire economies and financial markets. His innovative strategies, such as risk parity, helped to redefine the hedge fund industry and brought Bridgewater substantial success. Now, under Ray Dalio's leadership, Bridgewater Associates has achieved remarkable success. All the funds have consistently generated high returns and have attracted over $150 billion in assets under management. But in my opinion, the most impressive is Ray's all-weather portfolio. Now, this portfolio is supposed to perform well regardless of the type of economic environment we are in, and has done incredibly well. Since February 2006, the all-weather portfolio has a compounded rate of return of 6% a year, or over 200% return. Also, if you look at this chart where the purple line is the performance of the all-weather portfolio, it has outperformed the 60-40 portfolio, which is the orange line, which consists of 60% stocks and 40% bonds. As well, it has outperformed the S&P 500 index, which is the blue line. But the most impressive aspect of the all-weather portfolio is it has incredibly small drawdowns during major stock market crashes. Now, as you can see from this chart, the all-weather portfolio, which is the purple line, only had a 12% drawdown from the highs in 2009 versus the S&P 500 index, which is the blue line, which dropped almost 60% from the highs. One of the hallmarks of Ray's success is his unique investment philosophy. Now, he has articulated his principles in the best-selling book called Principles. Now, the book outlines his beliefs and practices in investing and management, and has a profound impact on the way investors approach the financial markets. Now, I want to highlight 3 key aspects of Ray's approach to investing. The most important fundamental aspect of Ray's investment strategy is risk parity. Now, it involves allocating investments in a way that balances risk across different asset classes or stocks, and where there's not one single asset class or stock that dominates the risk in a portfolio. This approach is intended to provide more consistent returns regardless of the economic environment and reduce the overall impact of asset classes or individual stock volatility on portfolio performance. Now, let me explain this concept further using a stock portfolio. Now, when investors allocate capital to different stocks, they usually determine the number of stocks that they want to have in their portfolio and then divide the capital evenly amongst all the stocks. So, for example, if you have a $100,000 portfolio and you want to build a portfolio of 10 stocks, then you would buy $10,000 worth of each stock. But this is not what you should be doing. In risk parity, you would allocate capital to investments based on the risk contributed by each stock and ensure that each stock contributes roughly an equal amount of risk to the portfolio. To implement risk parity, Ray would calculate the risk contribution of each stock in the portfolio. And this would involve assessing how much each stock can impact the overall risk of the portfolio. For example, let's say you only allow a 10% maximum risk and you have 10 stocks in your portfolio. Now, for simplicity's sake, let's allocate an equal 1% risk in each stock. Therefore, if the value of a stock declines by 1% in your overall portfolio, then you would exit the stock. As well, volatility, often measured using standard deviation, is a common way to quantify the risk of a stock. For example, if certain stocks like Tesla are historically more volatile than bank stocks, such as JP Morgan, then the portfolio may require a smaller allocation to Tesla stock to minimize risk. In addition, the investment portfolio should be diversified across a broader range of asset classes beyond just stocks. Now, other asset classes may include bonds, commodities, real estate, currencies, and even crypto. Now, the goal is to find assets that have low correlations with each other so that their returns are less likely to move in the same direction at the same time. Another one of Ray's investment philosophies is to understand economic cycles. He believes that understanding where an economy is within the economic cycle is crucial for making successful investment decisions. Now let me walk you through 4 stages of an economic cycle. The initial stage of an economic cycle is where you see inflation rising and the economy experiencing strong growth. And this is where equities, commodities, and real estate may perform well. As well, during this stage, it's common for central banks to raise interest rates to combat inflation. The second stage is when inflation begins to slow down and the pace of economic growth also decelerates. This is where bonds can be attractive due to falling interest rates, while certain defensive stocks and assets like gold may also perform well. As well, central banks may start to lower interest rates to stimulate economic activity. The third stage is where there's a severe downturn in the economic cycle, and deflation, characterized by falling prices, can lead to economic depression. And this is where government bonds and safe haven assets like gold tend to be more favored. Also, during this stage, central banks typically implement aggressive monetary policies, including lowering interest rates and engaging in quantitative easing to prevent a full-down depression. The final stage involves a gradual return to economic growth and potentially rising inflation. Now, this stage is characterized by efforts to reflate the economy, often through fiscal stimulus measures and accommodative monetary policy. Therefore, stocks may again become attractive along with commodities and other risk assets. The last core aspect of Ray Dalio's investment philosophy and approach to life that I want to highlight is his principles-driven decision making. Now, he believes that having a set of well-defined principles helps individuals and organizations make more effective decisions and navigate complex situations. Now, Ray interprets principles as essentially guidelines or rules that serve as a framework for making decisions. Now, they're like a set of beliefs or values that help individuals and teams stay aligned in their decision-making processes. Now, Ray encourages individuals and organizations to explicitly identify and define their principles. And this involves taking the time to reflect on what values and beliefs are most important and relevant to the specific context, whether it's investing, business, or personal life. One of the key benefits of using principles is that they help reduce the emotional biases in decision making. You see, emotions can cloud judgment and lead to impulsive or irrational decisions. Principles provide a rational and consistent framework for evaluating options. As well, principles promote consistency in decision making. When principles are clearly defined, individuals and teams can hold themselves accountable for adhering to those principles. And this consistency contributes to better long-term decision making. Lastly, principles provide a foundation for making decisions that is not solely reliant on an individual's judgment or intuition. Now, this consistency is particularly important in high-stakes situations such as investing, where emotions can have a significant impact on outcomes. Thanks for watching. If you like this video and want to learn more about how the top traders in the world trade, click on the videos on your left and also on your right. I'll see you guys all in the next video.